Hi, this is Mani from bsc2nse.com. So in this video, I'm going to talk about a particular delta neutral strategy based on Nifty options. Um, so these values that I've loaded here are based on today's data and just for an example, because the example is more clearer than if I just theoretically explain. So yesterday Nifty closed at 8450 or around that. So I'm going to choose that spot, and I'm choosing I've put up the call option prices and the put option prices of 8450 call and 8450 put, which is at the money call and at the money put. Okay, and then I'm choosing a level at the upside 8750 here, where I don't think markets will cross by end of this expiry or settle down on expiry. It may cross for a few days, but then eventually I believe that it will not sustain by expiry this level on the upside. Similarly, you choose a safer level on the downside, and I've gone for a farther level on the downside because I expect next 1 year the markets to be kind of negative and more downside possibilities than upside. So you can see that I've chosen a farther contract on the downside, and the put option value of 7900 put is 22, and the call option value of 8750 is 31. So basically in this strategy what we're going to do is while entering itself we're going to kind of make sure that the cost of investment becomes zero and the margin amount gets blocked, of course, because as I've marked here, I've marked it as green because we will buy one lot of 8450 call and one lot of 8450 put at 136 and 139, pretty much the same values because they are at the money. And as you can imagine here, we're gonna sell 4 lots of 8750 call at 31 rupees. So 4 lots multiplied by 31 rupees will be 124. So you will collect premiums of 124 rupees, which is not exactly the same as 139, but you're pretty much recovering the cost that you made for investing in the 8450 call here. Similarly, on the put side, we're going to sell 6 lots of 7900 put, which is at 22. So 6 multiplied by 22 is 132 points. So we're going to recover 132 points by selling this. Again, keep in mind that we are actually picking the level first where we think Nifty will not cross or go down below for this month based on the chart, looking at the chart and asking yourself the question as to which is a safe level. The idea is that by end of this month, the options that you sell on both the side will become zero, and Nifty should stay within this entire range of 7900 to 8750. So we will recover the entire cost we made by investing on the at the money call and at the money put. Okay. So basically, don't look at the prices and decide the level. Rather, look at the chart and ask yourself where Nifty is not gonna end the expiry above or below. Choose those levels and look at the premiums, and then you can fill up these values and decide how many lots you need to sell. Okay. So let me show you. This is a Nifty chart with the Bollinger Band here, and at the right you can see that it's almost at 8450, and yes, it's recovered a bit from 8000, and at the upper Bollinger Band is around at 8650 now. Of course, it can expand and go up, but then historically, if you see to the left, you can see that the previous lows there was a resistance at there's a resistance at 8600. This is the previous low which happened around 8600 to 8500, and then there's a resistance at 8700. So there's a couple of resistance zone here, 8600 and 8700, and I chose 8700 and then again another 50 points away just to be safe. And then previous peak here which made was 8800 from where it fell. So 8750 is a pretty good level, I thought, on the upside where Nifty should not sustain or end the expiry. And similarly on the downside, 7900 is the lower Bollinger Band, and currently it's on an uptrend, so I would not expect it to end below 7900 by end of this month. So that's how I chose the levels, and let's now see what's the profit percentage that you will need, or the margin that you will need to sell to enter into one lot for this strategy. To sell 4 lots, I think per lot the margin required to sell an options contract is 12,000 rupees. So for selling 4 lots and 6 lots, 10 lots put together, the margin you will need is approximately 1.2 lakhs. And to buy at the money call on both the side will be approximately 25 multiplied by 260, that will be around 7,000. So the margin, total margin required in this case would be approximately 1.3 lakhs. So I'll put that on a separate sheet. I'll empty this. So total margin required is approximately 1.3 lakhs per lot. And let's see what's the profit potentials. Assuming I'm just going to assume on the day of expiry, assuming if it ends at 8750 exactly. Okay, so you're going to make 300 points, or the call option, whatever you, again assuming that you've recovered the entire cost by selling the call option. Assuming it goes to 8750 or settles exactly there, the call option premium from 139, it will become around 300 rupees on the day of expiry. So 300 multiplied by 25, you would be in profits of 7,500 rupees, since this cost is already nullified by selling this. So the maximum profit potential on the upside, I'm just going to mark uh, max profits on upside is 7,500, and 7,500 on 1.3 lakhs should be approximately 6% returns. And then on the downside, assuming it gets to 7900, the 8450 put should become 550 rupees. That's a max that you can make. Max profits on downside. So 550 points multiplied by 25. Let me get the calculator quickly. By 25, you'd be in gains of approximately 13,500. It says 13,750, but I'm gonna just roll it over to 13,500. 13,500 is approximately like 10% returns on your capital. So that's a pretty decent returns. And this is max profits, and max profits on the upside and downside, assuming the levels are not breached. And let's say it only goes to by 200 points from at the money call, assuming 200 points above or 200 points below, then you would be in profits of 200 multiplied by 25, which is approximately 5,000. So whatever level you choose to enter at the money, you also need to make sure that it will not end at the exact same point on expiry. If it does end exactly here at 8450, then every option that you see here becomes 0 by expiry. And again, 1 week before expiry itself, the faraway contracts will become 0, but the at the money will still have some value, so you can still exit with some profits, assuming it's just settling down here. Or you can, what you can do is you can cut off, this will almost become 0, the faraway contracts, both the faraway contracts, assuming markets are still revolving around 8450 in the last week of expiry. So you can square off the 4 lots in 8750 call, and you can bring it closer in the last week like 8600. Sell multiple lots to collect excess premium, and all those excess premium will be profits, will be adding to profits. Similarly on the downside here, you can do that. You can realign on the last week. So a lot of other fine tunings you can still do, which I'm not putting into the maximum profits that can be made. But I will leave it up to you and your imaginations. There are a lot of fine tunings that you can do. You can even convert the normal position that you are selling here, convert it into MIS, and 60% of the margin needed will get unlocked during the intraday. You can use that margin for intraday option selling strategy. I think I made a video the other day, the expiry week option selling strategy, wherein you can make up to 5% to 10% in that week alone. So you can use that additional margin by converting to MIS and use that for relatively very safe strategies like that. and earn some additional premiums and earn some additional profits that you can add to the 5%, 10% that can be made in this strategy alone. So again, on the downside, let's discuss the downside. Um, on the downside, assuming markets crosses this level and finishes at 8900, if it's finishing at 8900, then the 8750 call will become 31 rupees will become 150. So you'll be in losses of 120 points per lot, and for 4 lots you will be in losses of around minus 480 points. This thing you will be in losses of minus 480 points, but 8450 call, assuming 8900 it ends, you will be in profits here, wherein this will become 450, or I'm gonna put it here on the left. Assuming it ends at 8900, the call option here will become 150, and you will be in losses of 120 points per lot. So for 4 lots, you'll be in losses of 480 points, and this will become 450. Yeah, and you'll be in profits of per lot 300 points. So it still lose only like 180 points in losses. So 180 by 25 will be less than 5000 rupees in losses. And again, that is assuming you are still watching and letting Nifty cross this level and you are still not exiting. Normally what you can do is you can cut out the losses minimally while it is crossing, assuming it has just crossed 8750 and there's still 2 weeks of time. If there's only 1 week of time left when it's crossing 8750, the premium will be very less. It will be probably only at 60, 70 levels, and at this time you will be only in losses of 40 points here. So for 4 lots you will be in losses of 160 here. I'm just taking a scenario there, and in this case here you will be in profits of already 300. The premium should be around 350 because there's again one more week there, or 330 at least. Okay, so again here you are in profits of approximately 200 points. Let me put it yeah. Okay, so in this case you will still come out with profits of 40 points at this point if you square off both the 8450 call and the 8750 call which you sold. If you sell that entire combo on the upside, you can still come out with marginal profits of 40 points, which is 1000 rupees. Even when Nifty is actually crossing the levels that you predicted it will not cross. So, and again this side will still be there, and even if Nifty reverses and comes below 8450, this thing will still earn further more profits, and this thing you can realign back and push it up. So you can do some fine tunings like that towards the last 2 weeks of expiry. Now the good thing with I'll explain the good things about this strategy is, similarly on the downside, if it does breach below 7900 close to the last week of expiry, or just 1 week before that, it's the same calculation holds true, and you can calculate and you can still come out in profits while it is just crossing this level by selling both the at the money put and the faraway put. So this is why I said it's a delta neutral strategy. The only period where I see that you can make lot of losses is if the markets does a lower circuit or an upper circuit wherein market goes up or goes down by 20%. Now what happens when that happens is this will go to, let's say, 20%, it will be 1600 points. At that time you may pretty much lose almost 60-70% of your capital, because assuming 20% upside from here will be like 11,000, and so 11,000 will mean that each lot of that you sold here will become 1200 points, and there will be losses of around 1200 points on all 4 lots, so that will be close to 5000 points in losses. But this call option here will become 1500 points, which should be in profits of around 1400. So the net losses will be around 3500 points, multiplied by 25 will be approximately 70k, 80k. So pretty much 70-80% of your capital will get wiped off. Or on the other hand, that the profits that you make over a period of like 2 years will get lost in one upper circuit or a one lower circuit. But I don't think that the upper circuit lower circuit happens only has happened only during an elections, 2004 elections, 2009 elections. Even on the day when Chidambaram made some P-note announcement, market went down by 10% only to recover on the same day totally. So I don't think that the chances of that happening is very less, like 0.001%. So while I say that even if it happens once in 5 years, you would still be in profits. And always keep reinvesting this profits, whatever premiums that you collect every month. So it can be like 7,500 in profits or 13,500 in profits per lakh. So you can keep, again, this is extremely good returns because you're making around, you can very easily make around 2% to 10% returns in a month, which is extremely cool. And Like I said, keep in reinvesting in the, I mean, don't use the additional premium to do more lots in the future. Keep investing the premiums that you collect into long-term equity portfolio, so that on the day when it hits upper circuit or lower circuit, you're not affected by much. By that time, all your profits would have already been in equity in your proper long-term portfolio, which should have again gained a lot. So you should eventually be in really good profits. That's it for now. Any questions, any queries, post on this video, and subscribe to our YouTube channel, and join our trading group and get a free training session. That's it for now. Thank you. Bye bye.